session. We're recording this session, so if you would like to watch it again later, we'd be delighted to just email me at sean@abm.ie and I'll provide you with the recording. As some of you may be aware, this morning it has a half-an-hour CPD, which has been sanctioned by the Life Insurance Association and waiting on the Institute of Bankers. And those of you that are solicitors, accountants, and otherwise, it's it's kind of self-declaration CPD. So therefore, I can give you the email from the LIA, and then you can use it which for your own organization if you're audited. We'll be having a Q&A session at the end. You may see in your screen there that down the bottom there's actually a chat box function, and you have the option of emailing everybody or communicating with everybody or communicating directly with Andy, and he can answer the questions towards the end. Now, our plan is to run this session for half an hour. If we run over the half an hour, then you can leave it when we're in the Q&A session, or you can stay on. So just to remind you that this morning's speakers is Andy Ivory-Core from New Ireland. Andy is head of investment sales at New Ireland. He's in this role since 2006 and has a great history in the financial services industry. He's skilled in portfolio management, financial planning, wealth management services, life insurance, and pension funds. Before great inflation ever happened, Andy actually got a first-class honours from UCD. I went there myself, and it wasn't a first-class honours, so well done, Andy, on that. Andy, in his spare time, is passionate about cycling. He's actually just back from Italy, having spent a few days cycling in Italy. So I'll hand you over to Andy.
Great, Sean. Thank you, and good morning, everybody. I'm just going to leave people in as they arrive, and thanks for the opportunity to speak with you this morning. So yeah, I suppose this morning's session, having spoken with Sean and Owen on this, it's in an environment like we're in right now, it's to maybe look at the macro of what's happening in the world, but also then really to concentrate behaviorally on how do we try to deal with, I suppose, as investors, how do we deal with the circumstances that we find ourselves in with a market year to date that has been pretty difficult. So as Sean said, happy to take questions as we go, or likewise, whilst it is a half-hour session, more than happy to stay on at the end and answer questions individually if people have more time and would like to chat through any of what we cover off this morning. I suppose just one point I will make is that on these sessions, I'm sure everybody will be aware that I can't give generic advice to anybody on the line, because such advice has got to be based upon your own individual circumstances. I think the key really from anything you pick up from me in the next half an hour, really, if it resonates with you, I think the key really is to have a chat with either Owen or with Sean, so that it can be applied to your own personal circumstances rather than just taking the generic advice of what I covered this morning. So Sean made an interesting point. I think where we find ourselves at the moment is an environment in which many people working in this industry today, many fund managers actually have never actually worked through a period of rising inflation. And what we find ourselves with is, over the last 12 months, what I'm showing you here are a range of different investment funds from within the New Ireland stable. Now, the reason it's irrelevant of them being New Ireland funds here. These are mainly passive investment funds. So what these will give you is an absolute proxy for what the underlying assets are doing. And I always think it's better to use the reality of what people are invested in rather than just squiggly lines to demonstrate a point of where investment markets are at. What we can see is there's far too many pointing left on this graph, and at this point in time, only one pointing right. So we see here, I think the last 12 months has certainly questioned our view on what the definition of safe assets are, because cash is negative, but more importantly, if you look at the red line, which is government bonds, almost down 14%. And I think the one that surprises most people is that kind of green line in the middle, where you can see it's down just shy of 21%. That's long dated government bonds. Whilst equities, we can see the bottom two lines. I will raise, most importantly, the bottom two lines to here. Everybody thinks about equities and shares has been the biggest problem in markets at the moment. Actually, what the market has given us year to date, you'll see the bottom two lines are equities. One is down about 1.5%. The other is down just over 11%. The difference between those two bottom lines is it is the MSCI World Index, but one is unhedged for currency, whilst the other is hedged. What that demonstrates to us is that as euro investors, we've been quite fortunate because of the strength of the dollar versus the euro in the last 12 months, that as euro investors, about 65% of the world index is comprised of US equities. Therefore, we've had quite an amount of benefit from the strength of the currency as a non-euro currency, but as a euro investor. So don't be, I suppose, or I think it's important for people to be aware of just the impact currency has had in investment returns over the last 12 months. And what that demonstrates to us is that cash over the last 5 years has also been negative, in fact, for longer than 5 years. And as an industry, what we're told is that that cash is considered the lowest risk investment. I would always say to every investor, when you consider the concept of risk, you really need to be as aware as you can be as to what is it that constitutes risk for you. Because if risk is volatility, in other words, the variability of markets, yes, cash has probably been the safest place to be for the last 5 years. But if risk to you as an investor is not meeting your long-term objectives, or more importantly, not over the medium to long term keeping your returns ahead of inflation, well, then actually I think we have to really think about what assets we need to be invested in order to generate that objective or to generate that return. And also then, in many respects, turn on its head what we consider to be risk. Risk to different people can be many different things, but I think what you need to do as an investor is ultimately be aware of what are the biggest risks to you based upon your own individual objectives. From a commodities point of view, one of the positives that we've seen in markets in the last year or so has been commodities. That has been driven by the Ukraine war, as I'm sure everybody is aware, sadly, for what's been happening to the people over there. But what we have seen is since the 9th of June, we've seen a bit of a pullback in some of these commodity prices. So I've put in a green arrow there. So you can see year to date is showing you what the actual commodity has returned either positively or negatively. And then underneath that, since the 9th of June. And the reason I put this in is because what we really don't know at this point is, was the 9th of June a peak in commodity prices, or is this a temporary pullback that we've seen in the last couple of weeks? The way I think we need to look at this is that in the initial months of this year, the commodity spike was because of the war in Ukraine, because of potential shortages globally in both foodstuffs and energy prices. What the world is beginning to consider now is, are we now going to see all of this create recession in both the US and in Europe? And then in doing so, if we do create a recession, does that mean that demand will significantly fall off for some of these commodities? And this may well be, I suppose, the reason why we're seeing these prices come back over the last couple of weeks. So we have this ongoing push-pull, which is, are we going to see the shortage of supply continue to see prices rise? Or are we now looking at the potential of a shortage of demand? And is that why we're seeing prices fall? So as always, commodities remain quite a volatile asset class. But I think it's important for investors to recognize that within your investment funds, even if you don't have a direct commodities fund, what you will find is that some of the underlying equities or some of the underlying assets that you may hold in that fund may well indirectly be benefiting from the rise that we've seen in commodity prices in the last number of months. So for investors today, before we move to the behavioral piece, I think what this means is that you'll be familiar with the equity market that trades on what we call a price to earnings ratio basis. That means if you look at a market that is trading on 15.7 times average earnings, that means that if you were to buy the entire market based upon the earnings, the after-tax profits that the companies have made within that market, it would take 15.7 years of earnings in order for you to own that entire market outright. Think of it as a company. If you bought a company on a multiple of 15.7 times earnings, it would simply mean that if that company could maintain the level of earnings that it is generating right now, in 15.7 years, the company will have completely paid for itself. What you can see by the graph here is that we've come back from a point of almost 25 times earnings, now down to a point of 15.7 times earnings. That tells us that the market, whilst it has sold off in the last number of months, has become significantly cheaper than it was, which you could argue represents value for investors who may be considering moving in today but taking a long-term view. These numbers mean very little over the short term. I would really highlight that to everybody. Don't ever take any of these numbers as been a short-term indication as to what the market might do, but what they can be is a very good indication of what a long-term market might do. What I would say to everybody is take note of the very last 4 words on the heading of this slide, because I think this will be important for us as investors. When we see the price to earnings come back, what's happened is that the prices have fallen in the last number of months, which brings back that overall price to earnings. What we now need to make sure over the coming months and quarters is that the E in the PE begins to hold up, and therefore that the earnings that we now expect to come through over the next number of months actually start to come through. If we start to see earnings cutting back significantly, or companies significantly falling short of their earnings expectations, that could start to see equities fall a little bit further, because then the E in the PE will actually be the shortfall that will see prices fall back from here. So I think for investors, the 4 things to really consider at this point in time in terms of where this market might go. And I'm not a believer in forecasting. I think forecasting in an environment like we're in right now is pretty futile. But I think what we can look at is, where do we think things like inflation, interest rates will go? Right now, it looks like inflation will be the big driver of markets. As we know, inflation takes spending power out of the economy. And if spending power comes out of the economy, the question we've got to ask ourselves is, will that inflation drive a situation whereby we get any sort of a significant recession globally, been caused by the lack of spending power that you and I, who are impacted every time we move to get petrol or to get diesel, or every time we walk into a supermarket today, we are now beginning to really see the impacts of inflation on our spending power. The problem central banks are faced with is that after years of quantitative easing, really what they've got to try to do now in terms of dealing with this inflationary issue is to raise interest rates. And again, when interest rates raise, we see the cost of our mortgages go up, we see the cost of car loans go up, the cost of servicing credit cards go up. That again brings or takes spending power out of the economy and creates a situation where, again, rising interest rates may well lead to recessionary environment right across the world over the coming months. We still don't know, but it is looking likely that there'll be some level of recession driven by these rising interest rates and inflation. Right now, the markets are pricing a 3% policy rate in the US by the end of the year, with a typically suggested at this point 0.75% rise in July, a 50% raise in September, and another 25% increase in November. Their forecasts, who knows whether they will come through. This time 12 months ago, I think the Fed were suggesting there will be no interest rate rises in 2022. Hence why I would suggest the futility of taking some of these forecasts too seriously. In the UK, we've seen interest rates already rise 5 times at this point in 5 different meetings, looking like a policy rate of about 3% by the end of the year. You'll get different forecasts on this, but this is what the market appears to be looking at. And the ECB are becoming a bit more aggressive. The implied rate by the end of the year at this point is 1%. So I think we can all expect the potential for a 25 basis points raise in July, and perhaps then a 50% raise in September. That's creating a situation where the bond market, where interest rates rise, when inflation rises, typically bond yields rise, and when bond yields rise, bond prices fall. And this has been a big problem for investors in the last number of months, because typically when equity markets sell off, what typically happens is the money comes out of equities and goes into government bonds. That drives up the price of government bonds at a time when equities are falling. So what that creates for us as investors who are diversified is that the rising bond market can help to offset the falling equity market. At this point in time, sadly, year to date, what we've seen is that inflation and interest rates rising have seen bond yields rise. That has seen bond prices fall at the same time as equity markets have been falling. So some of the diversification benefits that we would normally expect within investment portfolios haven't held through in the environment that we found ourselves in the last number of months. And finally, the squeezed dollar on the left-hand side, what that signifies is the, I suppose, the question mark on where quantitative easing goes from here. We know quantitative easing, which was the printing of money central banks globally, we know that that is coming to an end or has come to an end. The question now becomes, do central banks now start to sell down the assets that they've been previously buying over the last 8 or 9 years? And then if that happens, quantitative easing potentially becomes quantitative tightening. That could create further volatility for markets. So I think central banks have a really delicate balancing act to play over the next number of months to try to control inflation whilst not putting up interest rates too quickly, and also whilst trying to ensure that we don't see too significant a level of recession coming through in the environment we find ourselves in. So I think behaviorally, I guess part of this morning really in chatting with Owen and Sean was, how do we deal with environments like we find ourselves in right now? And in difficult markets, the headlines can certainly test our resolve. This is from 2020, March 2020. I think it's a fascinating graph because we saw huge volatility in markets, as we know, in February and March of 2020. But this is a great example of demonstrating the noise in the markets. If you look at the back of the screen, and this is a real graph taken from a television screen, you can see the Dow's best week since 1938. That would typically be a great time to be buying equities, and we saw at that particular week equity markets were rallying. But what fascinated me about this was, if you look at the ticker tape running across the bottom, breaking news, more than 16 million Americans have lost jobs in 3 weeks. Both of those headlines will tell you a very different story. One should have seen the markets sell off significantly. The other should have seen the markets rally significantly. And what it demonstrates to me is, if you're constantly reading and hearing and listening to the noise of the market, which one of those two headlines should you have acted on? I think the question is, for most of us over the short term, neither of them is the answer. And this is a good graph to demonstrate the importance of us, I think, as investors, keeping a long-term perspective that can be really difficult over a very short period of time. So when we look at the top of this graph here, we can see what looks like a pretty volatile investment period for investors. These are the times where we get scared. These are the times when we typically can be inclined to make sort of emotional decisions about our investments, which can come back to bite us at a point in the future after making those emotional decisions. But what I'd love to, I suppose, ask you to zone in on is, if you take the top of that graph and then look to the bottom of the graph, and we've put that top half in context over a longer term investment, and we can see that when you zoom out over a 10-year chart, daily, weekly, even monthly swings become barely noticeable. And this gets back to the whole concept of why we would always say, in an environment like we find ourselves in today, we need to remember, as a long-term investor, trying to ignore the short-term market movements, whilst it can be difficult, really is the thing that most of us should try to do. And just to take the context of what I've just said and bring it through to today, this is the MSCI World Index, that's the World Equity Index, over the last 5 years, up to yesterday. And what we can see is that the current falls bring us back to where we were just about June of last year. So as a 5-year investor, we can see that the world index is still up almost 60%. And if you went back over 10 years, obviously those numbers become even more significant. So sometimes we can find that the short-term news, what's happened in the market yesterday, what's happened in the last month, can be a disproportionate influencer on an investment that we may be having in place for the next 5, 7, 10, or even 15 years. And I think the message really for most of us is to try to not let those short-term market movements be the dominant factor in making short-term emotional decisions. And many of us on the line will be familiar with this gentleman who's now in his 90s, probably the most successful investor that has ever lived, Warren Buffett. And he says that what's required for successful investing is sound intellectual framework for making decisions, which obviously is of huge importance, but then the ability to keep emotions from corroding that framework. What we see in an environment like this all of the time, and as Sean said, I'm 16 years working with New Ireland, but I've previously worked in private banking, and I've previously worked in stockbroking. And it doesn't matter what level we're at, these markets create high levels of emotion. And you'll see from the headline that I've put on this slide, it's one I use all of the time, which is that these markets, we end up paying a high price for what we call emotional liquidity. What do I mean by emotional liquidity? In many instances, we can find ourselves deciding to make a change to our investment portfolio whereby perhaps we decide we can't take this volatility anymore and we move to cash. In the main, what we tell ourselves is that we will move it to cash in case the investment falls further and in case we need the money. So actually what we think we're doing is we think we're making an investment decision based upon the potential of financial liquidity. Actually, what we're doing is we're running out of emotional liquidity, and it's that lack of emotional liquidity that can be the driver of us making a change to our portfolio, rather than really it being anything to do with financial liquidity. And I thought it would be interesting just to share with you some history to the stock market. You've probably seen various different versions of this. This is the S&P 500, the top 500 companies in America. I'm showing you every single year's returns of that index going back as far as 1926. Why have I chosen 1926? Well, that's when official records began for the S&P 500. The American stock market is around for a lot longer than that, but the S&P officially in 1926. And really what I just want to demonstrate to you is I can't tell you what will happen in the future, neither can Sean or Owen, but what we can say is if 100 years of history is anything to go by, the red rings is showing you the periods of significant decline, and we can see there have been some really big ones, 1929 to 32, 40 and 41 during the World Wars, again in the oil crisis of the 70s. But the interesting point is, if you look at the red arrows, typically the best days in the market come after the worst. Now, if you were in a situation where you could miss all of those worst days, well, then it mightn't matter that you then subsequently miss the best days. The problem is that in a market like we're in today, typically when we get the really bad days, we then make the decision to change our portfolio, not because we've got a monetary requirement for the money, but because we've run out of emotional liquidity. And in doing that, we then move to cash, or we move to something that's of a much lower risk. And what we find is that the market then rebounds, and you will generally find that it'll be a number of months into that rebound before we build up the nerve or the courage to go back in. And my question that I would always ask to every investor is, if you make the decision to move out, who makes the decision to move back and when? Because in terms of doing that, what you have to be able to do is time the market. And in 23 years of working in investments, it's all I've done for 23 years, I've yet to meet anybody who has the ability to successfully time the market. But what we do know is, based upon making an investment, is that the probability of loss significantly reduces with time. So I would always have had a phrase that I use in seminars and in educational presentations down through the years, which is that investing is about time in rather than timing. And this is a study that just shows you that if you look at 1 month, so take the very bottom of this graph, take your X and Y axis, over 1 month, if you said to me, what are the potential chances of me losing money from the equity markets over a month? I would say to you, you have about a 40% chance. Therefore, take any month from 1871 through to March 2020, any 1 month, you have a probability of about 40% of losing money. But as you can see, as you go further out to 1 year, 3 year, 5 years, and 10 years, the probability of loss significantly reduces with time. And this is the point, I think, why when you hear investment advisors or you read investment articles where, if you're investing in the markets, having a 5 to 7 year time frame, the reason for that is because it typically allows you to be able to work through the variances of the market, where you might get 5 really good years followed by a bad year, or 2 really bad years followed by 3 or 4 really good years. Over time, the probability of loss significantly does reduce. The one thing I would always suggest to investors particularly in an environment like we're in right now, where, you know, it's difficult to be diversified. It's difficult to find an asset class that is going to give you that diversification. But what you need to be aware of is this phenomenon in investing called the behavior gap. And this is real. This is where studies are done every year, where we look at the returns of assets right across the world. It's typically done with equities, which is shares. And we can see that the difference between what an investment has returned, and if we take the US equity market as an example, versus what the typical investor has returned, can be quite significant. In fact, it can be anything up to 2, if not 3% per annum. So the difference between the box on the left, which is the investment return, and the box on the right, which is the investor's return, is what's known in the industry as the behavior gap. And that's typically where, unfortunately, we can be inclined to be driven into short-term decision-making based upon the environment that we find ourselves in today. And that decision made today can be to sell low and then find ourselves at some point going back into the market and buying high. And that difference is what's called a behavior gap. And that's one of the areas that we would suggest in an environment like today that investors should be very, very careful about decisions they make when those decisions are made through emotions rather than through the logic of why I want to make a change to this portfolio, taking a long-term view. Jason Zweig says it really well. Investing isn't about beating others at their game. It's really about controlling yourself at your own game. And to back up some of the points I've just made, and again, I hope you can see that I'm not trying to in any way tell anybody individually what they should or shouldn't do. I hope what you can take from this is conceptually, how should you think about, you know, making any decisions in an environment like we find ourselves in today. Since January 1928, again, we're using some US equity market statistics here. If you just simply bought the market on what we call a buy and hold, you can see there on the left-hand side, your annualized return. That's your real return from investments over that period. If you're out of the market on the best 50 days, you can see your return is significantly reduced. If you're out of the market on the worst 50 days, you can see the return is significantly increased. But if you're out of the market on both the best 50 and worst 50 days, you can see it's actually no different to simply the buy and hold strategy that is simply saying, forget about what the market does over the short term, take the highs and take the lows. If you can give it time, if you're a long-term investor, the key really is not to try to time finding the best days or finding the worst days. I will openly admit, if you can find the worst days and you can find the best days, yes, that'll be fantastic. That'll give you a great result. But as I say, I have yet to meet anybody who has the ability to time the markets and get it right all of the time. This is, again, just historical returns by holding period. It's really what I want to try and do in this slide is to try to back up the points I'm making to you about it being time in rather than timing. And on the left-hand side here, you can see equities is the gray bar. You can see bonds is the green bar. And the blue bars is simply a 50-50 portfolio. If you had 50% in equities, 50% in bonds, you can see there the 1-year rolling average. What that demonstrates to you is that, you know, you have a high percentage chance of a loss over any 1 year. When you go to 5 years, your percentage chance of loss is significantly reduced. And as you go to 10 and 20 years, again, I think, and I hope what this graph demonstrates is that investing is about time. It's time in, but not timing. And just over the last couple of slides, I'm conscious we're just coming up in a half an hour, how we frame a decision or how we frame information within our own minds can also be hugely, hugely important. This graph is showing you the equity markets from 1970 to 2013. It's out of date, but it's irrelevant. It's the point I want to make by the graph rather than it being time sensitive that matters here. If you looked at that line, it doesn't look all of that scary. And I said to you, if you go from the x-axis up to meet that purple line and bring it across to the y-axis, that will tell you over any 10-year period what your annualized return would have been. So actually we can see there that there's only a minor period there in 2008 where over 10 years you wouldn't have had a positive return from equities. Every other single period, you can see there, you've had quite a strong annualized 10-year return by holding equities. That's the information as a long-term investor that we should base our decisions on. But the next graph I want to show you is typically the graph that we do make decisions on. And it's showing you the very same purple line, but we've overwritten it by the year-on-year returns of the market. And I think what you can see there is, if we base our decisions on the gray line, it becomes a much scarier place to be. Whereas in actual fact, both lines are giving you the very same long-term information with the very same long-term result. The only difference is how we frame that information, and then subsequently how we act on that information based upon the short-term emotions of what that gray line produces for us, rather than taking the longer-term perspective of what the purple line should produce for us. So 3 things I think people should consider in this environment. If you are nervous about the environment, it does obviously pose an opportunity for investing when you're buying things cheaper. But as an existing investor, 3 key things. What are my objectives, and have my objectives changed since I made the investment? Time frame, how long do I have? How long did I intend to invest for? Has my time frame changed? And how much risk am I both willing and able to take in order to achieve those objectives over that time frame? I would argue that unless one of those 3 things has materially changed since the time in which you originally invested, then making any decision to materially change your investment really needs to be questioned. And it really needs to be, ask yourself the question, am I making this as an emotional decision rather than an actual solid financial decision? And when you look through your portfolio in an environment like this, the key really remains to be diversified, have equities, have government bonds, have cash, have the right assets to suit your objective over that time frame. But more importantly, make sure that your exposure to those assets are within the level of risk that you're both willing and able to take. So it always goes back, from my perspective, whether as a new investor, what am I trying to achieve? How long do I have to achieve it? And how much risk am I willing and able to take? Or as an existing investor, reviewing your circumstances in the current market environment, the very same 3 questions. And then it all comes back to being in the right assets at the right stage in your investment journey to suit the level of risk that you're able to take during that investment journey. So I'm just 3 minutes over, but just the summary points, and then happy to take questions if there are any. Just to summarize, I think volatility is likely to persist through the rest of this year. There's very little on the horizon to suggest that it won't continue being volatile. But volatility and risk, you've got to make sure you differentiate them. Volatility is part of investing. There is no free lunch, and I say that to every investor. You've got to be willing to live with a certain amount of ups and downs with these assets. And again, as a long-term investor, the volatility dissipates with time. Try not to let short-term noise of markets disrupt the long-term investment plan. That's not telling somebody you shouldn't make a change, but just don't make a short-term change to a long-term investment based upon the noise of the market today. Mind the behavior gap. Whatever you do, try to resist buying high and selling low. It can create significant wealth destruction on people. Again, I can't tell anybody what not to do, but just make sure when you make a decision that you are recognizing whether or not you are perhaps prone to the behavior gap. Remember the 8th wonder of the world, which is compounding, but compounding needs time. You cannot compound overnight, so it just needs time to work. And therefore, if you make changes to your portfolio, you've got to be aware of the impact that might be having on the potential compounding effect over time. Manage downside risk where possible. Be mindful of what's popular, ESG, cryptocurrency, all of these things. Just be mindful of them. Don't change a long-term investment portfolio based upon, again, something that might be fashionable at the time. Environmental, social governance, hugely fashionable right now. It makes great sense. We do have to look after the world, but I would question the apparent huge success that ESG has created for people in their investment portfolios over the last year or 2. We won't get into it this morning, but I think there are some reasons why it's coincidental why some of these funds have done particularly well. Go into an ESG fund because you're environmentally, socially conscious, rather than it having anything to do with ESG being a better performer. Haven't time to discuss that this morning in more detail, but happy to take questions on it if people wish. Knowing your objective, consider your risk tolerance. It's timing that matters, and not timing. And finally, I think what's really, really key is, in a year like we find ourselves in right now, know what you own and know why you own it. And that's how having a good financial advisor helps, and being able to sit down with your financial advisor, go through your portfolio, recognize what's in there, why it's in there, what it's likely to do over time, and then just give the investment time to perform. So Sean, I know I'm 5 minutes over, my apologies. I'm going to stop sharing the slides at this point. And if there are any questions, I'm happy to take any questions.
Well, thank you very much, Andy, for your well-explained insights. Just remind people this morning's recorded, so if you want to see a recording again, just email me and I can email you on the recording. And likewise, if you want the CPD, email me. From our perspective, what we'd say is, I mean, feel free to go. It's now well past a half hour. We'd say is we'd have 3 do's and don'ts ourselves. And I'm repeating somewhat of what Andy said, is don't change your 5 to 7 year investment plan based on 5 to 7 or more months of bad results in the market. Another thing, what we hear from people is, should I increase the investment risk in my portfolio? Should I make a few quid? We're saying no. If your plan before, if you're medium risk before, stay with medium risk. If you're medium low, stay medium low. If you're medium high, stay at that. As Andy well explained, we're not trying to time the market. What we are being asked a lot of is, unlike 2 years ago in that bear market, there was nobody trying to buy the dip, or very few of, or it's called. These days we're saying there are a number of people buying in at a cheaper prices, but we don't know how long this cheaper will last. It could be a sale, but the sale could last another 12 months or more. But however, some people are opting to put more money into markets and are opting to pay their pension payments earlier. But really, that's our experience. Owen and I are happy to help you at any stage if you have any queries. We don't have any questions in the chat box. So unless the chat box is at the bottom of your screen, you should be able to see a chat facility if you want to put a question in there. Or if you have my mobile, I'll turn on my mobile, you can ring me. But in the lack of any questions, I think that's all good. And Andy, that was a very insightful explanation.
Great. Okay, Sean, well, look, thanks very much for the opportunity to speak this morning. Sean, I will just say to you, if any questions do come in, if anybody would prefer not to ask a question online, if a question comes in that you want to send in to me, I'm happy to try and answer it. Obviously, I can't answer based upon individual people's circumstances, but I'm certainly happy to offer an answer, as you know, to any questions that come in. So if people prefer to do that, just don't hesitate and let me know. Is that okay?
Great. Okay.
Great.
Thanks everyone. I think we close the session now, will we?
Great. Good morning and thank you.
Okay. Bye now. Thank you.
Okay, Sean, I'll close it down there now.
Yeah, I do. Okay, great. Thanks, Andy.
Okay, thank you. Bye-bye.